Welcome to today's Explainer. We've got a pretty wild one today. The United States government just officially crossed a financial threshold that honestly would have sounded absolutely impossible just a generation ago. $40 trillion in federal debt. But here's the thing about numbers that are almost incomprehensible. The most important part isn't actually the number itself. It's what happens after you reach it. So today we're going to follow the debt. We'll look at exactly how we got here, what it really means for the economy, and most importantly, what it actually means for your own financial future.
$40 trillion. That is a 4 followed by 13 zeros. It's a number so huge it kind of just loses all meaning to the human brain, doesn't it? And let me be absolutely clear right out of the gate here. This is not a projection, it's not some think tank estimate, and it's for sure not a social media rumor. This figure comes directly from the U.S. Treasury's debt-to-the-penny system. Reuters officially reported this milestone in August 2026, noting that the national debt has literally more than doubled in less than a decade. But, when a number gets this massive, our brains tend to just jump straight to worst-case scenarios.
So, the natural question you're probably asking yourself right now, and it's a completely fair one, is simple. Does this mean America is bankrupt? Well, the short answer is no. Reaching $40 trillion absolutely does not mean the government has to suddenly empty its pockets and repay everything tomorrow morning. It doesn't mean an overnight economic collapse, and it definitely doesn't automatically mean the U.S. economy can't support it. The real situation is far more nuanced. And to really understand whether this number is dangerous, we first need to understand what it actually represents.
To really wrap our heads around this, we've got to clear up one of the most common mix-ups in all of economics, the difference between the deficit and the debt. Think of it like your personal credit card. The deficit is your monthly spending gap. It's the amount the government adds to its borrowing in a specific period, just because it spent more than it collected in taxes. The debt, on the other hand, is the accumulated total of all those monthly gaps over years and decades. It's the grand total balance on that national credit card.
And that brings us to the staggering reality of our current deficit. Get this, according to Reuters and the Treasury, during just the first 10 months of the 2026 fiscal year, the deficit had already hit roughly $1.8 trillion. That single 10-month gap actually exceeded the entire deficit of the previous fiscal year. To put that into perspective, that is like putting over $5 billion on the national credit card every single day. So the $40 trillion milestone, it isn't a static finish line. Because that deficit machine is still running hot, the total debt is actively growing every single month.
But hey, before we totally sound the alarm, we actually need to slice that $40 trillion into two distinct buckets. The Treasury separates total debt into debt held by the public and intragovernmental debt, which is essentially just the government owing money to its own trust funds, like Social Security. Now, when economists try to evaluate the true borrowing burden on the U.S. economy, they focus almost entirely on the debt held by the public. That's the money actually owed to outside investors, and it's the number that really impacts financial markets.
So how exactly did we build this massive mountain of debt? Well, it wasn't one president, it wasn't one law, and it wasn't just one political party. This is literally a multi-generational story built through economic cycles and historic crises. In the 2000s, you had recessions reducing tax revenue, while wars increased spending. Then came the 2008 financial crisis, which required massive emergency programs. Fast forward to 2020, and the COVID-19 pandemic forced dramatic emergency support for households and businesses. In fact, roughly one-third of the entire increase in federal debt since 2017 happened just during the pandemic.
Which brings us to a really crucial twist in the story. The emergency ended, right? But the deficit didn't. The pandemic was resolved, the emergency economy disappeared, but the massive government borrowing? It stuck around. We're no longer in a crisis, yet we're still borrowing like we are. And that irony right there sets the stage for a much larger problem when the economic weather inevitably changes.
Because here's the thing, the real villain in our story isn't actually the principal amount of the debt, it's the interest. I mean, imagine borrowing $40 trillion when interest rates are hovering near zero. No big deal, right? But now, imagine having to refinance all that debt when rates are significantly higher. The Congressional Budget Office projects that federal net interest outlays, literally just the cost of paying the interest on our credit card, will jump from roughly $1 trillion in 2026 to $2.1 trillion by 2036. The cost is going to more than double in a single decade. To put that into perspective, the CBO expects interest spending to rise from about 3.3% of the entire U.S. gross domestic product to 4.6% over the next 10 years. This is exactly why the headline number matters. The government isn't just sitting on an inactive pile of debt, it's being forced to dedicate an ever-increasing share of our national resources just to service it. Every dollar spent on interest is a dollar that's not being spent on infrastructure, or defense, or healthcare, or, lowering taxes.
Now, this brings a new major player into our explainer, the bond market. See, the U.S. finances itself by issuing Treasury securities, and investors demand a yield for lending that money. Recently, the 30-year Treasury yield hit elevated levels, reaching around 5.34%, which is its highest mark since 2007. Now, the government doesn't suddenly pay 5.34% on all $40 trillion overnight, because older debt is locked in at those lower rates. But as that old debt matures, the government has to issue new debt at these new, much higher market rates.
And right here, this is where the story leaves Washington, D.C. and enters your living room. Because long-term Treasury yields, they act as a baseline for the entire financial system. When the government's borrowing costs go up, financial markets adjust their reference rates. As a result, consumer mortgages, auto loans, credit cards, and corporate borrowing, they all become more expensive. The government's massive debt creates this upward pressure on the broader interest rate environment. So this isn't just an accounting issue for politicians, it actively dictates the price you pay to finance your life.
Now, I know you've probably heard the old rumor that foreign countries own all of America's debt. Well, the actual data easily debunks that myth. Yes, foreign investors are absolutely important. They held about $9.3 trillion of Treasury debt in mid-2026. Japan is the largest foreign holder at $1.12 trillion, and China holds roughly $633 billion. But look at the massive share that belongs to domestic investors, institutions, and government accounts. The vast majority of U.S. debt is actually owed to Americans.
But look, we also have to balance this picture, because the United States is absolutely not an ordinary household or your typical business. As global economists consistently point out, the US dollar is the world's dominant reserve currency. US treasuries are deeply, deeply embedded as the ultimate safe asset in the global financial system. And this unique position gives America enormous borrowing capacity that literally no other country has. In fact, Fitch even reaffirmed the United States credit rating at AA+ with a stable outlook in late 2026. So yes, we have enormous fiscal obligations, but we also possess immense, unparalleled fiscal strength. But having all that strength doesn't just make the math magically disappear. Eventually, the bill comes due, and the solutions are, to put it mildly, politically painful. To fix this, you really only have a few levers. You can increase revenue by raising taxes, you can brutally reduce spending, you can slow the growth of massive programs like Social Security and Medicare, or you can try to grow the economy faster than the debt. Every single option requires somebody to give something up. So if you've ever wondered why politicians naturally kick the can down the road, it's because touching any of these levers is a very quick way to lose an election.
So when looking to the future, economists are essentially split into two camps. The bull case argues that America's immense productivity, economic growth, and dollar dominance will simply make the debt manageable relative to the size of our expanding economy. But the bear case? Well, that warns of a vicious feedback loop. Large deficits require more borrowing creates more debt creates massive interest expenses, and those high interest expenses make it impossible to lower the deficit. It's a dangerous cycle that just forces trade-offs to become harder and harder.
So what should you actually take away from all this? Honestly, it comes down to this. The $40 trillion headline is just a milestone. Saying America is bankrupt would be completely ignoring the data. But dismissing the number would be an equal mistake. The raw dollar amount isn't the guaranteed crisis. It's the cost of carrying it. The rising interest expense, which is becoming a rapidly growing chunk of the federal budget, is the real warning signal flashing red for investors and taxpayers alike.
And that leaves us with one massive, lingering question. If the government's borrowing costs remain elevated in this new economic reality, that $40 trillion milestone becomes infinitely more expensive. What happens to the stock market in your retirement account, the mortgage rate on your next home, and the broader U.S. economy if these rates stay high? Well, that is a completely different story, and it's exactly where our next investigation begins. Keep learning, keep questioning, and I'll see you in the next explainer.